Your money is being devalued overnight. The biggest reset has begun. Police Scarlight. Welcome to Dalio Financial Empire. Something big is happening right now. It's not being announced loudly on the news. It's not trending on social media. But behind the scenes, the biggest financial institutions in the world are already preparing for it. Goldman Sachs, UBS, JPMorgan. Within a very short period of time, all three released research pointing to the same conclusion. The same asset. The same structural shift. And the same warning about where the global monetary system is heading. And almost none of this information is reaching everyday people. In this video on Dalio Financial Empire, I'm not just going to summarize those reports. I'm going to break them down in a way that actually makes sense. I'll explain what these institutions are quietly telling their wealthiest clients, why it matters to you, and what it means for your financial future. Because what's happening right now isn't just another market cycle. It's a reset. Let's start with the most important word in the title, devaluation. Most people think devaluation means a sudden crash, a financial crisis, big headlines. But that's not how it usually works. Devaluation is silent. It happens slowly, over time. And by the time most people notice it, it's already too late. If your savings account is paying you 3% or even 4%, it might feel like your money is growing. But if inflation is running at 5% or higher, your purchasing power is actually shrinking. You're not moving forward. You're falling behind. Not because you made a mistake. Not because the market crashed. But because the system itself is designed in a way that transfers wealth from savers to borrowers. And the biggest borrower in the world? Governments. Now this is where things get serious. The United States government is carrying massive debt. Every year, it spends far more than it collects in taxes. And that gap keeps growing. Interest payments alone are becoming one of the largest expenses. This creates a major problem. Because when a government can't fund its spending through taxes, it only has two real options. Borrow more money. Or print more money. And today, printing money doesn't mean physical cash. It happens digitally through central banks. But the result is the same. More money enters the system. And when more money is chasing the same goods, each dollar becomes less valuable. That's devaluation. Now here's the key point. The biggest financial institutions in the world already understand this. And they're not waiting. They're positioning. Let's start with Goldman Sachs. When Goldman describes an asset as constructive, that's institutional language for we expect it to go higher. And here's what matters. They stayed bullish even after a major price drop. That tells you something important. They're not focused on short-term price moves. They're focused on long-term structural trends. Their view is based on three core factors. Ongoing inflation pressure. Limited ability of central banks to cut interest rates. And unsustainable government debt. This isn't speculation. It's simple math. Now let's look at UBS. UBS adds more depth by identifying four major drivers shaping the current environment. The first is stagflation risk. Stagflation is one of the worst economic scenarios. Prices go up, but economic growth slows down. This puts central banks in a difficult position. If they raise interest rates, they hurt growth. If they lower rates, inflation gets worse. Either way, something breaks. Historically, during stagflation, certain assets perform well because they're not directly tied to the financial system. That's exactly what institutions are focusing on right now. The second factor is currency weakness. When a currency slowly loses value, it doesn't always make headlines. But over time, it reduces your purchasing power significantly. UBS expects this slow decline to continue. Not a crash. Not a collapse. Just a steady erosion. And that's enough to create a major long-term impact. The third factor is interest rates. Right now, central banks can't easily cut rates because inflation is still an issue. But long-term, high interest rates aren't sustainable. Why? Because governments can't afford to pay high interest on massive debt forever. At some point, something has to give. And when rates eventually come down, it changes the entire investment landscape. The fourth, and most important factor is central bank behavior. This is where the real story is. Central banks around the world have been increasing their holdings of hard assets at a record pace. This is not random. This is strategic. They are slowly moving away from a system they no longer fully trust. And then there's China. One of the most important and least talked about parts of this story. China has taken steps that could significantly increase long-term demand. Major financial institutions there are now allowed to allocate part of their assets into alternative stores of value. We're talking about tens of billions of dollars. This isn't short-term trading money. This is long-term capital. Money that enters the system and stays there. Now let's address something important. Recently, prices dropped sharply, and many people assumed that the entire idea was wrong. But that's not what actually happened. That drop wasn't about fundamentals. It was about liquidity. When large funds come under pressure, they sell whatever they can sell quickly. Not what they want to sell, but what they can sell. And the most liquid assets are usually the first to go. This creates temporary distortions in price. But it doesn't change the underlying reality. In fact, during that same time, physical demand stayed strong. That's a powerful signal. Because when price goes down but demand goes up, it usually means one thing. The market is mispricing the asset. And eventually, that imbalance corrects itself. So what does all of this mean for you? It means we are entering a new phase. A phase where the old rules no longer apply. Where traditional ways of saving and thinking about money are being challenged. The biggest risk is not volatility. The biggest risk is holding assets that are slowly losing value without you realizing it. At Dalio Financial Empire, the mission is simple. To help you understand these shifts before they become obvious. Because once something becomes obvious, the opportunity is usually gone. Here are 3 questions you should always ask. What are major institutions actually doing with their money? What is the general public doing? Are the forces behind this trend short-term or long-term? Right now, the answers are clear. Institutions are positioning for a major shift. The public is still largely unaware. And the forces driving this change are long-term. This isn't just a market story. This is a monetary shift. A slow reset of how value is stored and preserved. History shows that when governments face massive debt, the outcome is almost always the same. Currencies lose value. Not overnight, but steadily, quietly. And the people who understand this early position themselves ahead of time, while others realize it only after their purchasing power has already declined. So the real question is not whether this reset is happening. The real question is, will you recognize it in time? Because in a world where money can be created endlessly, the most important decision is not how much you earn. It's how you protect what you've already earned. This isn't fear. This is awareness. And awareness is the first step toward making smarter financial decisions. If you found this valuable, stay connected with Dalio Financial Empire, where we break down complex financial ideas into simple, practical insights. Because the biggest opportunities, and the biggest risks, are often the ones no one is talking about.